Why bother investing when you can get 5% return on your savings? It's a great question, and in this video, I'm going to give the answer on our views on this tricky subject.
So today I'm going to take you through the reasons that actually this choice doesn't have to be one or the other. This is not just about whether you save or whether you invest. This is a question actually that the answer is it's best to do both. So let's talk about it. When we think about savings, what rates are there available at the moment? And so when we look at the different market rates available, this is what pops up. You can see there, we're talking around about 5%. Some of those banks you may have heard of, some of those banks you may not have heard of. Generally speaking, the typical rate you're getting there, sometimes around Santander, Leeds, Yorkshire Building Society, you're getting about 4.6 to 4.8%. That's pretty good savings rate right now. And remember, we are in that really unusual situation right now where savings rates are actually higher than inflation. Inflation at the moment is 2.2%, somewhere around there, whereas you can get 4.6% on your money. That doesn't happen often. And so it makes sense right now, if you've got a little bit of savings, actually using savings rates and receiving interest that's higher than inflation actually means you're making a positive return for the first time, really in a long time, on your savings, which is fantastic. But what happens when those savings rates fall? Because as of last month, the Bank of England had their first interest rate cut. They cut rates 0.25% from 5.25 down to 5%. And once the central bank and the Bank of England, the US central bank's exactly the same, but once a central bank starts down a path, they will continue along that path unless something else happens. So what I mean by that is we have now in the UK started on a rate cutting path. We will continue to see interest rates being cut over the next year, 18 months, maybe even 2 years, unless something significant happens that forces the Bank of England to stop that. What could that be? Well, it's pretty much only one thing that's going to stop that, and that's inflation. So, but at this point, we have inflation very much under control. Inflation is around 2%, far, far lower than the horrible 10% it was 12 months ago, and there's no real sign that's going higher anytime soon. So the Bank of England will start cutting rates more over the next 12 months. We expect that. That means these savings rates that you're seeing on the screen will continue to fall as well. So just because you put your money into an account at the moment, which is achieving 4.6%, say, if those rates get cut, your savings rates, or the interest you receive on that money, will also get cut as well. So you won't continue to receive the 4.6%. Just something to keep in mind when thinking about savings rates. Now, the other aspect I want to talk about when thinking about savings and thinking about cash is, like I said, it's not necessarily a binary answer to savings or investment. We actually see cash savings as a key part of one of the points of our financial plan. And when we look at our financial plan, we split it up into time frames. That's an immediate time frame, a short term, a medium term, and a long-term time frame. And when we think about that with a client's life in mind, we think, okay, let's map out these time frames across the client's life and across your life, and think about what money do you need at any particular point. What money do you need right now in the immediate term over the next 1 or 2 years? What money do you need in the short term, maybe 3 to 5, then medium at 6 to 10, and then long term for 11 plus years? And for each of those particular timeframes, we come up with an individual strategy. So the immediate term is a classic case in this. If you need money in the next 1 or 2 years, this could be for maybe school fees. This could be for a deposit on a flat or a house. This could be for an expense you've got coming out. This is money where you need access to those funds and you need the security of those funds. And you can see where I'm going with this. The security of funds is dictated by what the funds are invested in. And actually, there is no more secure place for money to be invested than cash. Cash generates, as we saw in the previous slide, about 4.6% at the moment, which is above inflation, which is not bad. In the short term, cash is a great holding vehicle because your money is guaranteed. Markets go up, markets go down, it doesn't matter. It doesn't impact how much cash you have in that account. So the classic case for this would be, let's say you're about to buy a house, you want to save for a deposit. In that situation, the last thing you want is your deposit to be invested in markets for that markets and potentially markets fall just before when you need to pay the deposit. Horrible scenario. I've seen it 1,000 times before. So when we think about immediate term planning, cash is king. Have the safety net. If you need the money in the really, really short term or immediate term, have the money as cash. Now, however, when we think about short, medium, and long-term planning, this is where cash becomes a bit of a problem because, as we said right now, cash is at 4.6%, but it's not going to stay there. So what happens over time if cash starts falling and inflation even might start rising? You're going to get to a point where inflation goes back above the savings rate because that's frankly what normally happens. In that situation, anything you're receiving on your cash, so the interest you receive, may well be less than inflation. That means in real terms, your cash is actually losing money over a long period. And that's where holding cash on a longer term horizon becomes slightly more dangerous. So the way we think about it, when we look at people's portfolios, we say, okay, when we're thinking of short, medium, and long term, we think about, okay, from a long term perspective, that is money that you're not going to need for 10 plus, 11 plus years. So we're thinking the classic one for this, if you're working and in your 30s, 20s, 40s, this is money that might be in a pension. We typically take the view, and of course, this is down to everyone's individual situation and attitude to risk, but typically we take the view that pensions should be in 100% equity funds. This is because these are growth investments. They are volatile, yes, but they also grow for you over time. The S&P 500, the biggest stock market in the world, has an average growth rate of 9% annualized over the last 150 years. The FTSE 100, the UK stock market, has an annualized growth rate of 8% over the last 150 years. No other asset gets close to that equity growth over the long period. However, it can be volatile. We all know that. We've all seen the 10 p.m. news with the headlines of stock markets crash around the world. They do that, and actually they do that quite often. But what we've seen is every time markets do that, as long as you give it time, as long as you are not forced to sell, markets have recovered. And if you base your investments on an index fund or an index, which is effectively, like I mentioned, the S&P 500 or the FTSE, over time, historically, we have always seen that crash followed by a bounce. And frankly, there is no reason to think why that won't continue to happen over our lifetime. So when we think about the planning, we start with the equity on the long term, and that's the growth asset. We have the very immediate term, we have cash, and then we split the short and medium term as a blended approach between the two based on each individual client and their comfort level with investing and the comfort level with risk. So for some people, it might be cash short term, 100% equity long term. Medium term might be 80% equity, 20% non-equity, bonds, things like that. Short term might be 60% equity, 40% non-equity, a blended approach. And as you can see, each particular time frame has a different investment strategy that aiming to achieve its individual goals over that time. So there we go. The answer to the question, is it better to have cash savings rates or investment? I've concluded the answer is it's best to have both done through a specific financial plan that's tailored for you. I hope you've enjoyed the video today. If you've got any comments, please come back to me. Please hit the subscribe button, hit the like button, and I look forward to speaking to you soon. Bye.